Jeremy, very nice of you to come by. Good to have you with us.
Thank you.
You wrote a classic book called Stocks for the Long Run. And in this environment, that sound has a ring to it that people will say, no, that doesn't work anymore.
Yeah, that's right.
Can you define your basic strategy?
The first edition came out actually in 1994, and it was based on research that I had done in the late 80s and early 90s. And yeah, there's been no question the most trying time for the long-term investor has been the last two years. What is interesting, I've updated all my data, is that all the long-term parameters still hold. The last 10 years have been a horrible 10 years. There's no question about it. They were preceded by the best 20 years in stock market history, where we got very overvalued at the top of the tech boom in 2000. If you just take the last 20 years, interestingly enough, the returns in the stock market are dead even with the long run average. So, you know, two great decades, the 80s and the 90s, got to an overvalued position, corrected down on the next decade. The 20-year look is still very healthy, by the way, over 6.5% after inflation as a 20-year return on the market today.
So the bottom line is, stick with it.
I think stick with it. And even though the market is up, you know, almost 100% from its March lows, my analysis says it's still undervalued. So you've missed some of the big gains, but I tell investors you have not missed everything by any means, and it's still a good investment.
Let's go into that. Historically, the PE ratio has been 15.
Right.
What is it now? And then make your case.
Right.
It should be higher than 15.
Well, it's lower than 15, which makes it attractive now. Right now, on the basis of 2011 earnings, we're at 13. On the basis of 2012, but we all know there's a lot of uncertainty, actually about 12 or 11.5. But let's stick with this year. We're over half the year over already in 2011. And we're getting more and more sure of what these earnings are going to be. We're at 13 times earnings. Now you say, but that's not so undervalued compared to long-run history. But the truth is, when we've had interest rates as low as they are now, this is an extremely attractive valuation. Because when we've had single-digit PE ratios in the 70s and 80s, that's when we had double-digit inflation and double-digit yields on treasuries, and that made big competition for stocks. In fact, what I've looked at is what is the average PE when interest rates are below 8%. We're nowhere near that today, and actually happens to be 19 in the last half century. So in a low interest rate environment, I certainly still believe that we have very attractive valuations.
So even though these rates are artificially suppressed because of circumstance in the Fed, you would argue even if say the 30-year goes to 6%,
yeah,
these stocks are still a bargain.
Yeah. Even the 30-year at 6%, which is a more normal interest rate, 6 to 7 actually over the whole period, then you could argue the 15 yield on the S&P, and we're nowhere near that. Those people who tell me, well, Jeremy, the interest rates can only go up. Should I buy stocks when interest rates go up? And the first thing I tell them is that, well, if you look at history, in the early stages of Fed tightening, that's not bad for the market. It's the later stages that gets the market. So don't worry about the first set of increases the Fed undertakes, whenever that might be, which of course seems to keep on being pushed further and further back as the economic data comes in.
Why are earnings doing so well when the economy isn't?
You know, GDP is not earnings, and there's a number of reasons for that. First of all, 40% of the S&P profits come from abroad.
Right.
And we know emerging markets are doing extremely well. We know Europe is in trouble, but emerging markets are doing extremely well. Secondly, the tax rate on these ever-increasing foreign earnings is lower And we have one of the highest corporate taxes in the world. So as that increased amount of profits comes from abroad, after-tax revenue goes up. Something else is also very, very important. As a country, we are hurt by higher oil prices because of the fact that we import 2/3 of our oil. But for the S&P 500, which has a lot of oil firms that have reserves around the world, it turns out they're not hurt by that. So you have a stake in the material